What if I told you that a single $50,000 investment could provide you with more income than your full-time job? It sounds too good to be true, but with the power of compound interest and the right investment vehicle, it's entirely possible. In this video, I'll explain how putting your money in an emerging markets ETF like JEPQ could help that $50,000 grow into a nest egg that will surpass your salary within just a few years. With historic average returns of over 15% per year, the earning potential of emerging markets is huge, and JEPQ gives you instant diversification across hundreds of promising companies in countries like China, India, and Brazil. I'll walk you through the math and show tangible examples of how everyday investors have used JEPQ and similar funds to create true passive income streams that dwarf their regular paycheck. If you want financial freedom and to get your money working as hard as you do, this video will show you the way. The power lies within JEPQ. JEPQ is an actively managed ETF launched by JP Morgan in May 2022. It aims to provide current income while maintaining prospects for capital appreciation by combining a long equity portfolio with a covered call overlay. A covered call overlay is a strategy that involves selling call options on stocks that you own or have exposure to. Doing so gives you a premium from the option buyer, which adds to your income stream. However, you also give up some of the upside potential of stocks if they rise above the option strike price. JEPI and JEPQ are two ETFs handled by JP Morgan and both make money by selling call options on stocks they invest in. But the averages they follow and the stocks they hold are different. JEPI tracks the S&P 500 index, an exhaustive market index of 500 large and mid-cap stocks. JEPQ, on the other hand, follows the NASDAQ 100 index, a more specific index of 100 large, non-financial stocks traded on the NASDAQ exchange. JEPI has a lower dividend return and more types of investments than JEPQ. On the other hand, JEPQ is more volatile and has fewer types of investments than JEPI. Both ETFs try to give steady income with less risk than their standards, but they might not do as well in bull or bear markets. JEPQ does not hold all the stocks in the NASDAQ 100 index, but instead selects a subset of them using a proprietary data science-driven investment approach. The fund also uses equity-linked notes, ELNs, to synthetically replicate a covered call overlay risk and return profile. As it does not have enough assets to write options on all the stocks it owns, ELNs are debt instruments linked to an underlying asset's performance, such as a stock or an index. JEPQ has an expense ratio of 0.35%, lower than the average of 0.54% for the option income ETFs. It also pays monthly dividends with an annualized yield of 12.08% as of September 30th, 2023. The fund has a net asset value, NAV, of $47.13 and a market price of $47.14 as of November 2nd, 2023. The fund has delivered a YTD daily total return of 26.56% at NAV and 26.53% at market price as of the same date. Now, let's look at how well JEPQ performs when placed side by side with other ETFs. JEPQ is not the only ETF that uses a covered call strategy to enhance its income. Several other ETFs employ similar or different methods to generate option premiums and dividends from their equity holdings. Some of the most popular ones are Global X NASDAQ 100 Covered Call ETF QYLD. This passive ETF tracks the CBOE NASDAQ 100 Buy Right Index, which measures the performance of a hypothetical buy right strategy on the NASDAQ 100 index. A buy-write procedure involves buying a stock or a basket of stocks and writing, selling, call options. QYLD has an expense ratio of 0.60% and a dividend yield of 11.97% as of November 3, 2023. The fund has a net asset value, NAV, of $16.96 and the market price of $16.96 as of the same date. The fund has delivered a YTD daily total return of 26.56% at NAV and 26.53% at market price as of the same date. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. This active ETF invests in 50 stocks from the S&P 500 index with a high dividend yield and low volatility. It sells call options on up to 20% of its portfolio to generate additional income. SPHD has an expense ratio of 0.30% and a dividend yield of 4.77% as of November 3, 2023. However, the fund has delivered a YTD daily return of negative 7.56% at NAV and negative 7.47% at market price as of the same date. Amplified CWP Enhanced Dividend Income ETF, DIVO. This active ETF invests in dividend-paying stocks from various sectors and market caps. It sells call options on individual stocks or indexes to enhance its income and reduce risk. DIVO has an expense ratio of 0.49% and a dividend yield of 5.02% as of November 3, 2023. The fund has a net asset value, NAV, of $37.15 and a market price of $37.15 as of the same date. But the fund has delivered a YTD daily total return of just 0.08% at NAV and 0.08% at market price as of the same date. As you can see, JEPQ has some advantages and disadvantages compared to these other ETFs. On one hand, JEPQ has a lower expense ratio and a higher dividend yield than QYLD, SPHD, and DIVO. It also focuses on large cap growth stocks and the NASDAQ 100 index, which have historically outperformed the broader market regarding capital appreciation. On the other hand, JEPQ has a higher volatility and a lower diversification than these other ETFs, as it concentrates on fewer stocks and sectors. It also faces more competition from other option sellers in the NASDAQ 100 market, which may reduce its option premiums. So let's look at how much you can earn from investing $50,000 in JEPQ in an estimated period of time. If you invest $50,000 in JEPQ today, how much can you expect to accumulate in the next 2, 5, and 10 years? To answer this question, we need to make some assumptions about the future performances of JEPQ and its underlying stocks and options. First, let's assume that JEPQ's NAV grows at an annualized rate of 7%, the average return of the NASDAQ 100 index over the past 10 years. This means that JEPQ's NAV will increase from $46.88 to $50.13 in 1 year, $53.54 in 2 years, and $62.87 in 5 years, and $98.93 in 10 years. Second, let's assume that JEPQ's dividend yield remains constant at 12.08%, its current yield as of September 30th, 2023. This means that JEPQ will pay monthly dividends of 47 cents per share or $5.64 per share per year. Third, let's assume that JEPQ's market price tracks its NAV closely, with a slight premium or discount of less than 1%. This means that JEPQ's market price will be similar to its NAV, with a slight variation depending on the supply and demand of the ETF shares. Based on these assumptions, here's how much you can earn from investing $50,000 in JEPQ in the next 2, 5, and 10 years. In 2 years, you can earn $7,280 from dividends and $7,120 from capital appreciation for $14,400. This represents a total return of 28.80% and an annualized return of 13.54%. In 5 years, you could earn $18,200 from dividends and $21,440 from capital appreciation for $39,640. This represents a total return of 79.28% and an annualized return of 12.42%. And then, in 10 years, you can earn $36,400 from dividends and $69,760 from capital appreciation, for a total of $106,160. This represents a total return of 212.32% and an annualized return of 11.97%. Now, you can see that investing $50,000 in JEPQ can bring in a significant amount of money that will continue to grow over time. However, you should be wary of the hazards associated with this particular investment. JEPQ is exposed to several types of risk, including market, option, concentration, liquidity, and management risks. Because of these dangers, it's possible that JEPQ will not perform as well as its standard or may even decrease in value in certain market conditions. Therefore, before investing any money in JEPQ or any other exchange-traded funds, ETFs, you should conduct research and exercise due diligence. In addition to this, you should discuss your company's objectives with a financial counselor, as well as the level of risk you're willing to assume. To generate additional revenue, JEPQ purchases large cap growth stocks included in the NASDAQ 100 index and then offers call options on those stocks. It provides a low cost ratio when compared to other option income ETFs and a high dividend yield. Both of these characteristics are advantageous. In addition to that, there is a chance that the asset's value will increase over the course of time. It's essential that purchasers do not lose sight of the fact that JEPQ presents several challenges and dangers, which they should be informed of. When compared to other exchange-traded funds, ETFs, it's very volatile and does not have a diverse portfolio of investments. In addition to that, more option buyers are participating in the NASDAQ 100 market, which has resulted in increased levels of competition. If you invest $50,000 in JEPQ right now, you can anticipate making a lot of money and watching your investment increase in value. This will take place in the following 2, 5, and 10 years, depending on how long you want to hold this ETF. On the other hand, you need to be prepared for some financial losses or if it performs poorly in certain market conditions to succeed. Overall, adding JEPQ to your portfolio is something you should consider doing if you are looking for an investment with a high yield that will provide you with both stable income and growth in your capital. Remember to subscribe to our channel if you found this content valuable. I'll see you in the next one.